Good day, everyone. We are the Group 1, and I'm the leader of this group. My name is Jmar Bigarong, and here are the member, Harleen Di Valdivino, Mariels B. Cervantes, Melody Manalo, Ginos Ermino, Micaela Gonzalez, and Trixie Contemplacion. And our report is all about international monetary system.
Definition of International Monetary System. The International Monetary System is a set of conventions and rules that support cross-border investments, trades, and the reallocations of capital between different countries. These rules define how exchange rates, macroeconomics management, and balance of payments are addressed between nations. The International Monetary System structure was reformed after the North Atlantic financial crisis of 2008 to 2009. For additional information, the International Monetary System comprises central and commercial banks, international financial institutions, and various money market funds, including open market funds from the currency and bond markets. In their eyes, money is a medium of exchange that facilitates the exchange of capital flows, goods, and services across countries. Example of international monetary system. Country A borrows $100 million from Country B to finance its infrastructural development for a repayment schedule of 10% each year with interest. Due to the exchange rate fluctuations, Country A benefits from the dip in USD in the first year but pays extra the following year. However, member countries can maintain repayment schedules irrespective of the movement through BOP calculations. So despite the ups and downs of exchange rate, member countries like country A can use BOP calculation to maintain their repayment schedules and manage their debt obligation effectively.
The International Monetary System functions. Current account surplus. A current account surplus indicates that the value of country net foreign assets grew over the period in question, and a current account deficit indicates that it shrunk. Both government and private payments are included in the calculation. Capital accounts. The capital account is part of a country balance of payments. It measures financial transactions that don't currently affect a country's income, production, or savings. Their value is based on what they are expected to produce in the future. Balance of payments. The difference in total value of between payments into and out of a country over a period. These transactions consist of imports and exports of goods, services, and capital, as well as transfer payments such as foreign and remittances. Statistical discrepancy is equal to gross domestic product less gross domestic income. These two measures are in principle the same. The difference reflects less than perfect source data. The difference between demand and supply in national accounts, even though by definition the items should be equal in the national economy. They usually deviate from one another due to deviation in statistical sources, and they are not forced to be equal in the finished system of accounts. Change in reverse requirements. The reverse requirement is the proportion of customers' deposits a bank is required by the Fed to hold in reserve without loaning out. Required reserve ratio is sometimes used as tool in monetary policy, influencing the country's borrowing and interest rates by changing the amount of funds available for banks to make loans with.
Fixed baby wrap. Specially developed health suit and relax your baby. Fixed baby wrap now at only 49 pesos.
Stage of International Monetary System. Bimetallism. In this system, two metals, usually gold and silver, are used as the basis for a country's currency. The value of each metal is fixed in relation to each other, establishing fixed exchange rate between them. This system was prevalent in the 19th century but began to decline in the late 19th and early 20th centuries due to various economic factors. Gold standards. Under the gold standards, the value of a country's currency is directly linked to a specific quantity of gold. Countries would fix the price of their currency in terms of gold, and individuals could exchange the fixed rate. This system was widely adopted in the late 19th century and early 20th centuries but was abandoned by most countries during the Great Depression in 1930. The gold exchange standard. This system emerged in the interwar period following the abandonment of the classical gold standard. Under the gold exchange standard, countries held reserve not only in gold but also in other foreign currencies, mainly the US dollar. The US dollar became the primary reserve currency, and its value was pegged to gold. This system collapsed in the early 1970s due to various economic pressures, notably the inability of the US to maintain the convertibility of the dollar into gold. Bretton Woods system, established in 1944 at the United Nations Monetary and Financial Conference in Bretton Woods, New Hampshire. The system created a fixed exchange rate regime where currencies were pegged to the US dollar, which in return was pegged to gold. The International Monetary Fund or IMF and the World Bank were also established as part of this system to promote international monetary cooperations and provide financial assistance to countries in need. The Bretton Woods system collapsed in 1971 when President Nixon suspended the convertibility of the US, leading to transition to the current floating exchange rate system. The current floating exchange rate system. In this system, exchange rates between currencies are determined by market forces of supply and demand, with limited government intervention. Central banks may intervene in the foreign exchange market to stabilize their currency's values or address economic imbalances. But overall, exchange rates are allowed to fluctuate freely. This system provides greater flexibility and autonomy to countries in managing their monetary policies, but also introduces volatility and uncertainty into the international monetary system.
Good day everyone, I'm Micaela Gonzalez. I will be discussing the characteristic of international monetary system. First is flow of international trade and investment according to comparative advantage. The flow of international trade and investment based on comparative advantage operates on the principle of specialization and exchange. For example, in comparative advantage, each country is specialized in producing goods or services where it has comparative advantage, meaning it can produce those goods or services at a lower opportunity cost compared to other countries. Another example in trade, countries then trade their specialized goods and services with one another. They exchange what they produce efficiently for what others produce efficiently, but a relative higher opportunity cost. Overall, the flow of international trade and investments based on comparative advantage allows allows countries to maximize efficiency, promote economic growth, and achieve higher standards of living through specialization and mutual exchange. Number two, stability in foreign exchange and should be stable. Stability in foreign exchange refers to consistent and predictable value of a currency relative to others in the global market. For example, in trade, stable exchange rates facilitate international trade by providing certainty for businesses regarding the cost of importing and exporting goods and services. Number 3, promoting balance of payments, adjustment to prevent disruption associated with temporary or chronic imbalances. Promoting balance of payments and adjustments to prevent disruption associated with temporary or chronic imbalances involves several measures. For example, in exchange rate policies, countries can adjust their exchange rates to correct imbalances. For instance, if a country has a trade deficit, it can devalue its currency to make its export cheaper and imports more expensive, thus promoting exports and reducing imports to improve the balance of payments. Number 4 characteristic is providing countries with sufficient liquidity to finance temporary balance of payments deficits. Providing countries with sufficient liquidity of finance temporary balance of payments deficit is crucial for maintaining stability and preventing economic crisis. Here's how it can be achieved. For example, International Monetary Fund assistance. It plays a key role in providing liquidity to countries facing temporary balance of payments deficits. It offers financial assistance through various instruments such as standby arrangements, extended fund facility, or rapid financing instrument, which provides loans to member countries to address short-term liquidity needs. The last characteristic is should at least try avoid adding further uncertainty. In the international monetary system, it's crucial to avoid adding further uncertainty to maintain stability and predictability financial markets. This includes actions like sudden policy changes, unclear communication, or abrupt shifts and exchange rate regions. That's all. Thank you.
Figures. Let us discuss the key figures of the floating rate system through the point below. First, independence. In the floating rate system, the exchange rate is determined by push and pull of the market forces. There is no need for government interventions, which makes it more transparent compared to alternative system. The exchange rate is determined by market factors such as supply and demand for currencies. For example, let's say the demand for a particular currency increases to the higher foreign investment in a country. As a result, the value of the currency will appreciate relative to other currencies in the market. Number 2, constant fluctuation. A defining characters of the floating rate system is constant fluctuation of exchange rates. These fluctuations occur due to the various factors such as economic indicators, geopolitical events, and market sentiment. Exchange rate can change rapidly in response to these factors. For example, if there is sudden exchange in the economic outlook of a country, such a decrease in GDP growth, it can lead to decrease in the value of its currency relative to other currencies. Number 3, adjustments. The floating rate system allow for adjustments in a balance of payment or BPO between countries The balance of payment represents the differences between a country exports and imports, as well as other financial transactions. Exchange rate can play a role in settling surplus or deficiencies of funds between countries. For example, if a country has a trade deficiency, meaning it imports more than it exports, the value of currencies may depreciate. This depreciation can make it export relatively cheaper and export more expensive, helping to rebalance the trade of deficiencies. Lastly, number 4, transparency. Transparency in a floating rate system. Lastly, number 4, transparency in a floating rate system. Interventions from government or central bank do not bind the smooth conduct of exchange between countries. The fluctuation of exchange rates is driven by markets factor beyond the control of any individual or centralized organization. This transparency allows market forces to determine exchange rates. For example, if a country's central bank decides to intervene in a foreign exchange market by buying and selling its currency, it may have short-term impact on the exchange rate. However, the overall movements of exchange rates is driven by market forces. In overall, the floating rate systems provides independence, constant fluctuation adjustments in a balance of payments and transparencies. Is determined exchange rates. These figures allow for more flexible and market-driven approach to international currency exchange.
Critis white caramel, may sweetly nam-nam. Yumitutuyan ka sa sarap ng tamang timpla. Inagsamang sarap ng new coffee at cream caramel. Sweetie nam-nam, sweetie nam-nam, sweetie nam-nam. Critis white caramel, may sweetly nam-nam. Take a break at sweetly nam-namin ng bawang new great taste white caramel.
Importance and advantages of international monetary system. Number 1 is liquidity. Member countries are not limited to using one anchor currency. Therefore, countries can hold surplus or reserve cash in different currencies, resulting in a more significant liquidity factor than other systems. Number 2 is larger gains. Easing trade restrictions allow for the free exchange of currency, benefiting governments and central banks and allowing retail investors to experience greater gains through their trades. Number 3 is confidence. International systems in the past have come under the scanner for being manipulated and deceiving. However, the international monetary system is independent in terms of policy making. The policies leave the exchange rates to the market forces, leaving almost no rooms for manipulation.
Hello everyone, my name is Melody Manalo and for my topic is the evolution of international monetary system. Evolution. Since the 19th century, the international monetary system has undergone 4 stages of evolution at different points in time to form the structure as we know it today. Let us understand the occurrences that lead these changes and their current implication through the points below. First, the gold standard. Between 1880 and 1914, the gold standard was referred to as the monetary system through which each country could fix the value of their currency in terms of gold. The exchange rate was based on the determined value. For example, if the US fixed 1 ounce of gold is equal to $20, the United Kingdom had set the value of 1 ounce of gold equal to 10 pounds. Then the pounds dollar exchange rate would be $20 is equal to 10 pounds. The gold standard system had a fixed exchange rate system that facilitated the free convertibility of gold into national currencies and vice versa. The most significant advantage of this system was its ability to correct imbalances, as gold payment make balancing of easier, setting the balance of payment BOP deficits or surpluses could be easy, moreover the fixed exchange rate made international trade easier under the gold standard. Second, the war period. Between 1925 to 1933, between the world wars, the gold standard started losing its way. The war had created a dent in the world economy, and every country wanted to export more to revamp and rebuild their economies. Therefore, they significantly depreciated their currency's value to export extensively and benefit from economics of scale. This period of chaos and rebuilding saw exchange rate fluctuate and competitive devaluation unlike ever before. The Bretton Woods system. Only a few nations had the resources to survive after two world wars, while others struggled to feed their citizens in time like this. The United States of America and the United Kingdom started discussing the possibilities and ways to rebuild the world economy after two disastrous wars in the mid-1940s. The United Nations formulated the new international monetary system at the Bretton Woods Conference in Bretton Woods, New Hampshire. The Bretton Woods Conference to the creation of dollar-based the fixed exchange rate system. Under this system, the US dollar was backed by reserve gold. All other currencies did not have to maintain a gold reserve for conversion, therefore the conversion rate were minimal. The Jamaica system. Around 1971, high inflation rates and trade deficit lead to a gold process high. Therefore, the US had to stop the convertibility of gold. Owing to factors like this, the Bretton Woods system collapsed. Hence, the global economy moved towards a flexible exchange rate system in 1973 and by 1976. They formalized the system through the convention in Jamaica. Under the Jamaica or floating rate system, demand and supply would affect the currency exchange rates.
The current international monetary system. For the introduction, the current international monetary system serves as a framework that facilitates global trade and investments. It encompasses as a set of rules, conventions, and institutions that regulate financial interactions on a global scale. And the description. The system operates on a managed float system where exchange rates fluctuate based on market forces. Key currencies such as US dollars or USD, Euro, Japanese yen, and Chinese yuan play significant roles in the system. European monetary system. Established in 1979, the European monetary system laid the foundation for the introduction of the euro currency in 1999. The euro has become a dominant currency in the Eurozone, but it also faces challenges within member countries. Foreign exchange practices. Recommendations are provided for countries to either peg their currency to a specific value or allow it to flow freely in the market. Foreign exchange reserves held by countries have a substantial impact on global trade dynamics. Managed float and intervention. National authorities intervene in the foreign exchange market to stabilize exchange rates when necessary. Countries like Japan and China hold significant reserves to manage their currency values. For Jamaican Accord, the Jamaican Accord in 1976 introduced amendments that legitimize the use of floating exchange rates. Its special drawing rights, or SDRS, emerged as a principal reserve assets in this system. Evaluation and challenges. The currency monetary system has merits in supporting international trade and investments. However, the challenges persist, including exchange rate volatility and the disciplinary powers of institutions like the International Monetary Fund, or IMF. For the conclusion, the international monetary system is a complex framework shaped by historical developments and current economic dynamics. It plays a crucial role for policymakers, businesses, and individuals involved in global financial activities.
Teka lang! Huwag mo i-skip! Alam mo ba? Sulit ang 10 pesos sa Nescafe Classic. Get 3 sticks kesa 3 in 1.
Sarap ng puro at natural pa.
Nescafe Classic, 3 pesos lang.